In this video, we introduce the income statement and really begin what is the heart of this course. We first talk about the income statement and walk through all of its major line items and go through some exercises that are going to reinforce your understanding of the income statement. Then we turn to the balance sheet and are going to go through all of those line items and really spend a lot of time talking about how the balance sheet is connected to the income statement. And lastly, we really finish the heart of the course with the cash flow statement. And the cash flow statement really connects the three financial statements together. The very final thing that we talk about is financial ratio analysis and financial statement analysis. So once we understand how the three financial statements interrelate, we can start drawing conclusions and really perform some analysis on how a company's changing performance might need to be interpreted. But before we get into any of that stuff, we have to understand what the income statement is all about. So the income statement is a financial report that depicts the operating performance of a company, revenues less expense generated, and that's sort of the profitability of the company over a specific period of time, which is in reality typically over a quarter or a year. You'll also hear folks refer to the income statement as the consolidated statement of earnings, the profit and loss or the P&L, or the statement of revenues and expenses. The income statement is important because it facilitates the analysis of a company's growth prospects, cost structure, and profitability. Analysts can use the income statement to identify the components and sources of net earnings, what actually drives profitability. So we're going to get into each one of these line items in great detail, but to give you a 30,000-foot view, the major typical components and definitions of the income statement are revenues, and that represents the top line, all of the dollar payments for goods and services that are recognized by the company for a particular time period. Then you have cost of goods sold, which represent the direct cost of manufacture or procurement for a business. Those are direct expenses. And if you subtract those direct expenses from revenues, you have a concept called gross profit. And from gross profit, to get towards the actual net profit of the company, we have to subtract general operating expenses of the firm, and those are called selling, general, and administrative expenses. For some companies, research and development expenses are then also removed. Companies with significant R&D expenses, those are recognized separately on the income statement, usually below other operating expenses. That takes us to the core operations of the business, and then we get into a subject that we're going to spend a lot of time talking about, and that is the recognition of non-cash expenses like depreciation and amortization. And really, there are two very popular ways of measuring operating profits. One is a measure called earnings before interest, taxes, depreciation, and amortization, which really measures profitability before accounting for any of these non-cash expenses. And then we have the next measure of profitability is called operating profit, or earnings before interest and taxes. And that represents really earnings after you account for any type of operating expense or income item, regardless of whether it's cash or non-cash. The rest of the income statement is really factors in non-operating type of income and expenses. So interest expense, if you have any debt outstanding and there are costs associated with that, like making interest payments, but they're recognized really below core operating profit because these are non-operational expenses. This is expense that's tied to your financial or your financing decisions. Interest income is sort of the inverse of that. If you have a lot of cash or investments that are generating some sort of interest income, that's certainly income, but it's not revenue, and it needs to be recognized separately. And then we get into income tax expense and any unusual or frequent items that the company may have. And again, we'll spend a lot of time talking about that. And once you factor those out, the unusual income and expense items, as well as the income tax expense, the money that you owe to the government, you have your bottom line net income profit. The very last thing that you're going to see on income statements is you take that bottom line net income and you divide that by the company's shares outstanding to get to a concept that I suspect you've all heard of, and that's earnings per share, or EPS. And again, there are two definitions of EPS. There's basic EPS and then there's diluted EPS, and we're going to talk about the differences between both of those. So let's start at the top, revenue. Revenue represents proceeds from the sale of goods and services produced or offered by a company. Not all income is revenue. And so just recognize that a company can have other income streams. We already saw that there's interest income and things like that, but those aren't going to be related to its main operations. Really, revenue is income that is tied to the direct operations of the business. So interest income, income received from a legal settlement. These are not recorded as revenue, but rather as other income. Revenue is going to be called revenue, net sales, turnover outside of the United States. Let's go through a simple exercise just to make sure we understand what revenue really is. say July 2014, CVS, a drugstore chain, recorded the following transactions. It collected $450 million in cash. It sold $500 million in merchandise. It sold $100 million in prescriptions, won a legal settlement of $400 million, and collected $20 million in interest income from a bank account. If you hit pause for the moment, try to figure out what the answer is. Try to select which of these, there can be multiple ones here, that are categorized as revenue. And then we're going to go over what the right answer is. So hit pause now, give it a think, and then we'll move on. The answer is $500 million in merchandise and the $100 million in prescriptions are recognized as revenue. Let's talk about the reason why the other three are not. The fact that CVS collected $400 million in cash during the period does not affect revenue, and that's the accrual concept. It doesn't matter how much cash was actually collected. What's recognized is what is being sold. If they sold $100 million in prescriptions, sold $500 million in merchandise, that's what counts as revenue, not how much cash was collected. Next, legal settlement of $400 million. It's certainly income, but it's not going to be counted as revenue. It's going to be recognized below that operating profit line that we just talked about. And last but not least, $20 million in interest income from a bank account is the same story. It is certainly income. It's just not going to be counted as revenue.